Great. Thank you so much. It's a pleasure to be here, especially with so many people in the audience and on the panel that have worked on these issues. This is joint work with Moritz on dollar demand and international risk sharing. So this paper is motivated by now a large empirical literature documenting unique features of the dollar in the global economy. First, it is dominant funding currency for global banking, and that is weak when measures of risk premia are low and risk appetite are high. Second, carry trades which are short the dollar have countercyclical expected returns. Third, when US net foreign assets are low, they're rebalanced in part by a dollar depreciation via valuation effects, not just adjustments in the US trade balance. And fourth, US monetary policy shocks appear to have an outsized role in global risk pricing, a phenomenon that has been termed the global financial cycle. Now, these questions have gotten a lot of attention by economists over these last few years, as I said, but we would argue that existing frameworks are unable to fully account for these patterns together. And to focus on a couple salient strands of the literature on which we'll build, as I'll discuss, first, one strand of the literature has proposed the idea of the primacy of the dollar convenience yield and understanding the unique features of the dollar in financial markets. While these models are quite successful in explaining patterns of carry trade returns and aspects of monetary transmission, they are silent on the link between the dollar, risk sharing, and risk premium. Another strand of the literature has focused directly on differences in risk-bearing capacity, postulating that the US has a greater capacity to bear risk than the rest of the world. These models are quite compelling in accounting for the US's role in global risk pricing, but they have the paradox that they predict that the dollar should depreciate in bad times when relative consumption of the US falls. So what we do in this paper is propose a framework which bridges these two perspectives and strands of the literature that we argue can jointly account for these empirical patterns and moreover quantitatively fits the data. So in particular, we study a time-varying demand for dollar bonds in a new Keynesian model with heterogeneity and risk-bearing capacity in incomplete markets. We first argue that dollar demand shocks can rationalize the observed co-movements in the data. In particular, think about an increase in the liquidity value for dollar bonds, which we're going to think about as a dollar demand shock. As agents fly to dollar bonds, what's going to happen? First, in the presence of nominal frictions, the dollar is going to appreciate in financial markets, and there's going to be a global recession. As a result, the dollar is endogenously going to be a hedge, so that globally risk-tolerant agents, we're going to call them bankers, borrow in dollars. Under the assumption that the US is effectively more risk-tolerant than the rest of the world, matching the composition of its external portfolio, that means that through valuation effects, the US net foreign asset position in particular is going to fall before recovering. And so taken together, a positive dollar demand shock is going to lead simultaneously to a dollar appreciation, a global recession, and a decline in US net foreign assets, followed by a dollar depreciation, a global recovery, high excess returns in equity markets, and a recovery of US net foreign assets, exactly as in the data. We then argue that this shock and mechanism can help us rationalize quantitatively several patterns in the global economy. First, countercyclical returns on the dollar carry trade. In particular, a positive dollar demand shock, a flight to dollars, is going to push US interest rates low versus foreign interest rates. It's also going to lead to a recession disproportionately in the US, and that's going to forecast higher returns on the carry trade, borrowing in dollars and going long foreign currency going forward. Second, the US external position is going to be rebalanced in part through valuation effects. And in particular, a decline in the US net foreign asset position is going to forecast higher excess equity returns going forward, as well as a dollar depreciation as in the data. And finally, our model is naturally going to generate those monetary policy asymmetries. And importantly, it's not because monetary policy in our model has any effect on sort of the liquidity benefits of dollar bonds. Of course, that mechanism could exist, and as I'll discuss later, other researchers have emphasized that. Instead, it's going to be the asymmetric balance sheet composition of risk-tolerant agents versus risk-averse agents globally. In particular, risk-tolerant agents are going to be short dollar bonds. And so a US monetary policy easing is going to disproportionately redistribute wealth to them and thus lower global risk premia by more than a foreign policy easing. Finally, we're going to think about the effects of changes in the supply of dollar liquidity as a counterpoint to changes in its demand. And in particular, we'll trace out the implications for the supply of dollars, and in particular dollar swap lines that have been used in the Great Recession and in the present COVID pandemic. As we'll show, these swap lines are globally stimulative, particularly in the US, and we'll provide some numbers as a back of the envelope estimate to get a sense about what the expansion of the Federal Reserve's partner institutions in March of this year could have meant for the global economy in the depth of the crisis. Okay, unless there's any questions, let me get into the depth of it.
Rohan, can I just interrupt just to ask you about the framing of your question? First of all, okay, Moritz wanted to point it out, you have a little box at the top of your slides that says, please move this window, and he would like you to move that window away. I'm
not sure I can, but let's see. Thankfully, there's nothing there.
And then while you're trying to do that, let me ask you to say a little bit about you're thinking about a dollar demand shock. Should we think about this as particularly about the dollar, about any country whose bonds have convenience yields? As you go through the model, I think you're going to have the US having these bonds that have special value, but there might be other countries that have bonds that have special value. So what's the scope of what you're telling us?
Sure, that's a great question. So in many ways, the mechanisms that we're after are going to apply to any currency that agents fly to in times of crisis. And indeed, the whole part of the sort of the conceptual part of the paper is that endogenously, the crisis is generated by the flight to safety itself. Now, that's where the US is a bit special, because one of the implications, for example, of our framework is going to be if agents fly to countries that are bigger rather than smaller, the currency of the countries that are bigger are going to generate a bigger global recession than if they just simply fly to, let's say, the Swiss franc. And so I'm not going to really tease out those details in this talk. I haven't included that, but that is an implication, for example, of the economics that we've worked out. And I'm happy to talk more about that as we go along.
Okay, so in some sense, the Swiss franc would match some of the currency patterns in terms of the behavior of the exchange rate in your model, but maybe the macro spillovers are not as large. Is that what you want us to think?
That's what's one aspect of it. The other I would say is that I don't know exactly the composition of the Swiss external balance sheet, but we're going to follow in the tradition of Matteo and Pierre-Olivier and others who have argued that when you look at the structure of the U.S. external position, one way to rationalize it is the U.S. effectively more risk tolerant than the rest of the world. So that's going to generate dynamics of its external account, which again, for the Swiss, if their balance sheet looked different, that would also be different. But in terms of the pure co-movements of the currency with macro aggregates, the really only difference between the US and Switzerland is going to be size in our model. Okay, and forgive me for the box on the top of my slides. I'm not quite sure how to get rid of that, but hopefully it keeps you all entertained. Okay, so Arvin's question helped me a little bit situate the paper and literature. I'm not going to go through all these papers. We'll talk more about specific ones later. Let me just say at a big picture level how we think about what we're doing. First, we're sort of really focused on the interplay between the convenience yield and risk sharing, which so far have been studied largely in isolation. And second, we're trying to provide a quantitative account of a number of empirical patterns, whereas these literatures have tended to be full of mostly stylized models so far. Okay, so here's the plan for today. I'm going to first walk through the bare bone structure of the model. I'll walk through analytically the way dollar demand shocks work in our model, and then go to our full model, talk about how we parameterize it, look at impulse responses, co-movements, and then go through each of those applications. So let's get into the model. At a big picture level, it's a new Keynesian model of two countries, home and foreign. We're going to think of home as the US with capital. It's a workhorse framework, and to that, we add two sets of ingredients. The first are essential, a notion of dollar liquidity, and thus dollar demand, as well as heterogeneity and risk tolerance, both within and across countries. The second set of ingredients are not essential for the key ideas, but they're useful quantitatively for reasons that'll become clear. Epstein's in preferences, disaster risk that helps us better match asset pricing moments, and a perpetual youth structure to better manage the wealth distribution in light of differences in risk preferences. So let me give you the core guts of the model. Think about the problem of a home household I, and analogously for an agent in foreign. That agent is going to have Epstein's in preferences over an aggregator of consumption and disutility of labor. That consumption aggregator, CTI, is going to have a CES structure standard with home bias towards domestically produced goods. And what is the resource constraint of this agent? On the left-hand side, they choose consumption of home-produced goods and foreign-produced goods, as well as a portfolio of dollar bonds, BHTI, foreign-denominated nominal bonds, DFTI, and capital, which they rent out to global firms. On the right-hand side, they get some labor income, W times L. They also get the financial returns on their portfolio of dollar bonds, foreign bonds, and capital from the last period. And then they pay some transaction costs, which I'll talk about on the next slide. As I said, we're going to be thinking about heterogeneity both within and across countries, and we're going to have 4 agents in this model, bankers and workers in each country. And globally, bankers are going to be more risk tolerant than workers. That's the only dimension in which they differ. Okay, so as I said, aside from that heterogeneity and risk-bearing capacity, sort of this notion of dollar liquidity is the central kind of important ingredient in the paper. So let me talk a little bit about how we think about that and formalize it.
Before you go on, Rohan, can you just clarify? So in each country, there's bankers and households. Bankers are more risk tolerant than households. And across home and foreign, how are you parameterizing the differences in risk tolerance?
So effectively, bankers in each country are going to have the same risk tolerance. Workers are going to have the same risk tolerance. The measure of bankers versus workers is going to differ in the US versus the rest of the world to match the US's levered position in capital.
Perfect.
Okay, so how do we think about dollar liquidity? So we're going to think about dollar bonds as being able to economize on transaction costs that households face. And these transaction costs are denoted by capital omega T. Now, we're going to be, what that implies is, as you form your optimal portfolio, there's going to be an additional value of dollar bonds given by how much an additional unit of dollar bonds economizes on those transaction costs. And we're going to adopt a particularly simple functional form for that transaction value, which, as you'll see, permits a, I think, useful conceptual way to think about what's going on. So we're going to say that that marginal value of dollar bonds in terms of savings on transaction costs is given by some variable omega TD, which I'll talk about in a second, minus 1 over epsilon times how many bonds you're holding. What is the way to think about this? Well, omega TD is capturing by what amount holding more dollar bonds allows you to save on transaction costs, but the amount that it saves declines as you hold more and more of those bonds. And that's why there's a second term. Why is this functional form useful? Because we can aggregate it across agents very easily. And what do we get? We get that the value of liquidity, of dollar liquidity in this economy, is governed by 2 forces: a latent demand for liquidity, which is a driving force, omega TD, as well as the supply of liquidity from governments. Because by market clearing, the positions of the private sector in dollar bonds must be matched by the offsetting position of the government. And so what this means is that the price of liquidity is going up when omega TD, when the latent demand for liquidity is high, but it goes down when the supply of liquidity by governments, the amount of borrowing in dollar bonds by the government, goes up. And this epsilon parameter is sort of the elasticity of that demand curve. Now, for the purposes of what we're going to do for the next 30 minutes, right until the very end of the talk, this distinction is not going to matter. We're going to argue, following the literature on convenience yields that others have worked on, that we have a compelling sort of proxy for this net dollar demand, the balance of demand versus supply side forces. And that's going to be treated as a driving force throughout the paper. And so I'm going to call this omega T dollar demand, but I want you to remember it reflects both latent demand as well as supply of liquidity. At the very end of the talk, we're going to step back and ask how do changes, for example, in dollar supply through central bank swap lines affect the global economy. And there it's going to be important to take a stand on epsilon and this decomposition of demand and supply side factors. Okay, so as you can see, we simply have a price of liquidity omega T that's going to be floating around. How does it affect allocations? It's going to be through 3 central first order conditions.
Rohan, before you jump in, can I just ask a few more questions, and maybe it'll clarify in your next couple slides or your next bullet points. The liquidity is provided by government bonds here. Is this correct? What's your take on other private assets that might also be privately liquid? Are these dollar bonds supplied only by the US, also by foreign governments? And then just a minor question. You're denoting in your demand curve, it's BI over Y, where Y is rather than YI. which looks a little different than thinking about like a money demand curve. Maybe you can just comment on that.
Sure, thanks. Both good questions. So first, importantly here, all dollar bonds, even those traded among the private sector, are going to inherit this convenience yield property. All dollar bonds, including sort of privately created dollar bonds, which is some agent going out and borrowing using dollar denominated bonds from another private sector agent, those dollar bonds are going to be able to use as payment services. And so they're going to inherit these convenience yield properties. The point is when you simply aggregate across all the private sector, you're left with the supply of dollar liquidity from the governments. This distinction is going to be kind of useful and important as we talk about sort of the general equilibrium effects of these shocks, but the stand we're taking in the baseline model is that all dollar bonds, including privately created ones, have some convenience yield benefits. On your second question about YT, totally fair. Of course, there's decades of work thinking about money demand equations and so on, and we're absolutely taking a bit of a shortcut here. The reason we're choosing YT, which is aggregate output rather than YTI, is because as you can see, through aggregation, the price of liquidity has a very nice summary statistic, which is the debt to GDP ratio of the economy overall. And so we're going to be able to use, in fact, your work, sort of trying to identify this epsilon parameter from changes in debt to GDP ratios in the US, and thereby talk about the effects of, let's say, dollar swap lines on liquidity. But it's purely made, it's an assumption made for technical convenience, not for any deep reason.
Okay. Can I jump in? There's a question. Oleg has a question from the chat, which
Sure.
maybe you also want to address. You're going to sort of treat these omegas and the stochastic process for omega as a shock process here, which is going to have macro effects. And so Oleg's asking, to what extent do you want to take a stand that is the driving process, or is it a process that's correlated with other big macro shocks, which have which are the true driving process for what we see in the world?
Sure. Of course, this is, in some sense, the elephant in the room is what is this omega? And I think we think that, as you'll see, I think there's a lot of economics to be learned from understanding how this type of shock can propagate in the global economy, building on Oleg's work and others. There's two issues here. One is, can we account for the correlation between omega and other things going on in the economy? Absolutely. We can admit a rich correlation structure in the driving processes. Indeed, as I'll talk about, the implied, for example, level of the risk premium on dollar bonds or negative risk premium or safety premium is definitely going to depend, for example, on do these omega shocks happen in really bad times like disasters and so on. We can accommodate all that. There's a separate question, which is more about the Lucas critique, how policy invariant are these driving forces there? Absolutely, I think we're susceptible to that. I think for the balance of what we're doing, which is explaining how we can explain these co-movements in the data, to the extent we can convince you we have a reasonable proxy for omega, I don't feel like we need to overly apologize for it, but I think when you talk about policy counterfactuals, which we'll do at the very end, it certainly does matter. Okay, so how do these omega shocks filter through the economy? They're going to affect allocations through three central first order conditions. I'm going to present them for a particular agent at home, but it's also going to be true in foreign. First, between consumption and savings, you're going to see an omega shock pop in. That is, to the extent that I really want to hold dollar bonds, I really want to save rather than consume today. Second, between dollar bonds and capital, to the extent that omega is positive, I really want to save in dollar bonds rather than capital. And third, between dollar bonds and foreign bonds, to the extent omega is positive, I really want to save in dollar bonds rather than foreign bonds. Okay? So these three first order conditions, consumption, savings, bonds and capital, and domestic bonds and foreign bonds, that's where these dollar demand shocks are going to affect allocations, both at home and foreign. And I just want to pause for a second and contrast a bit how this is going to affect things in our model versus this growing literature on sort of the financial determination of exchange rates that is rapidly growing in popularity in our field. In particular, if one contrasts this with what's going on in Gebek's Maggiore or Oleg's work with Fatima, there sort of the focus is really on why are exchange rates so disconnected, apparently, from macro aggregates. And so there, the financial shocks that they focus on are really entering fundamentally the third set of portfolio conditions, just between foreign bonds and dollar bonds. And you're going to have some intermediaries sitting between intermediating these two markets. Our model shares that, but it also features these dollar demand shocks also affecting consumption savings decisions in every country and between bonds and capital in every country. And necessarily that's going to mean the exchange rate is less disconnected from aggregates in our model, but it's also going to generate some interesting co-movements and general equilibrium effects that I'm going to walk through in a second. Okay, finally, on the supply side, this model is very standard, so I'm just going to fly through it. Differentiated labor varieties, Rodenberg wage adjustment costs in each country. Production uses domestic labor and capital that's rented on an international market. Capital is produced with an unbiased aggregator, as well as adjustment costs in capital accumulation. There are Taylor rules on domestic CPIs with coefficients phi in each country. And so the summary of driving forces, global productivity process, including rare disaster, a time varying probability of the rare disaster to help us match various asset pricing moments, this dollar demand shock, omega, which I talked about, and then monetary policy shocks. And we're going to follow a fairly large tradition in the literature arguing these are not a huge driver of fluctuations on their own. So we're going to treat them as MIT shocks. So we can think about the Fed makes a mistake. Let's see what happens in the model compared to the data. But monetary policy themselves is going to matter through the Taylor rule, not through shocks that are affecting the global economy. So let me pause before I get in now to the nuts of the economics in case there's any questions.
I'm good.
Okay, let me keep going. All right, so what I want to do first is walk through the guts of what's going on in a simple case, which we work out analytically in the paper in the first part. So what are the assumptions we make here? A fixed global capital stock, so we don't have to worry about an additional state variable. Inelastically supplied labor from period 2 onwards, so there's no wealth effects in labor supply we need to worry about. Transitory dollar demand shocks, they happen once with no persistence. And identical per capita wealth. And we're going to study this model around a deterministic steady state using first and higher order approximations only for the next 2 slides. This is just to get some intuition. I want to emphasize everything we do in terms of the quantitative results of the paper, use a global solution. What's the plan? I want to first assume agents have the same portfolios, both within and across countries. That's going to allow us to isolate what is the role of nominal rigidity in mediating the effects of these dollar demand shocks. And then I want to think about the effects of heterogeneity in portfolios. Okay, I'm going to read through these results first, isolating the role of nominal frictions on prices, production, and the risk premia. I'm going to read through them and then I'll walk through the intuition. So think about a positive dollar demand shock in period 1. What's going to happen? With flexible wages and inelastically supplied labor, there's going to be a decline in the home real interest rate on impact. There's going to be deflation at home. There's going to be no change in other prices, nor the real allocation. And there's going to be ex ante, no risk premium on the dollar carry trade, that is borrowing in dollar bonds, going long foreign bonds in period 0. In contrast, with nominal frictions, there's going to be a smaller decline in the home real rate, a dollar appreciation on impact, a global decline in output, larger at home than in foreign, and a positive risk premium on the dollar carry trade in period 0. Okay. I'm going to walk through the intuition using these 2 central first order conditions. The first, again, the first order condition between consumption and savings, where M is the stochastic discount factor. And the second, the first order condition between dollar bonds and foreign bonds in each country. So first, think about the effects absent nominal frictions. Agents want to hold dollar bonds. What's going to happen is the real interest rate in the US is going to fall to accommodate that demand. And throughout the slide, there's a dance between financial markets and goods markets. In the case of no nominal frictions, that dance is easy. Once there's a decline in the interest rate in the US, that both makes agents willing to consume as much as they wanted to in goods markets. It also means they continue to be indifferent between saving in dollar bonds and foreign bonds. And so nothing else happens. In a nominal model, how does the interest rate in the US fall? Well, monetary policy must be doing something. In particular, there's deflation in the US. That deflation triggers a decline in the US nominal interest rate. And as a result, aggregates are unaffected. Because aggregates are unaffected, there's 0 risk premium on the dollar carry trade. It's not a price risk factor. Now, what happens with nominal frictions? With nominal frictions, monetary policy under the conventional Taylor rules is not going to lower nominal interest rates by enough in response to this dollar demand shock. As a thought experiment, think about it as follows. The only way monetary policy would lower interest rates is if there was deflation in the US. But deflation in the US is necessarily now going to be non-neutral because there's nominal rigidity. In particular, it's going to raise real wages. And so as a result, you have a smaller decline in equilibrium in the home real rate, a decline in consumption, a decline in production. That's in goods markets. In financial markets, how is the dollar demand shock accommodated? Well, if the US interest rate doesn't fall by enough, it must be that to make agents indifferent, the dollar appreciates on impact and then is expected to depreciate going forward. And so thus, the dollar is appreciating as global output declines. Now, how do these two things coexist? It must be that the decline in output is more severe in the US than in the rest of the world, curtailing the relative supply of US goods and rationalizing why the US terms of trade appreciate and thus the dollar appreciates in real terms on impact. Because the dollar has now appreciated in this endogenously bad time, ex ante, there is a positive risk premium on borrowing in dollar bonds and going long foreign bonds. And so I'll pause to take questions, but let me just point out these mechanisms very much echo some of the central points in the work of Caballero and Farhi and Gurinchas, who argue in their theory of safety traps that reserve currency issuers are exhibit these dynamics at the zero lower bound. And the point that we're making here is that these dynamics hold for conventional Taylor rules even outside the zero lower bound, and that we're going to argue quantitatively can rationalize a number of the co-movements of the dollar with other macro variables.
Okay, so Rohan, just to unpack the many things you said in the slide, one point you're emphasizing is, so take the case of normal rigidity. You're making an assumption of the Taylor rule that it's not responding to fully offset the dollar demand shock. If it did, there is some specification of the Taylor rule which would mimic the flex price equilibrium. The second set of things you're saying have to do with, given that exchange rates have to move to adjust to reflect the first order condition between home and foreign dollar bonds. And that's in the financial market, that's exchange rate appreciation. And then your related point is that in order for that to match the goods market equilibrium, we need to generate a bigger recession in the US than abroad. Maybe can you just expand on that last point and contrast it with, say, Matteo's mechanism in his job market paper?
Sure. So I think this will become especially clear when I'm showing some pictures in the next few slides, but let me just say that the key idea here is that in this model, we need the dollar to appreciate on impact. And what's going to happen, what has to happen to generate that? Well, the relative supply of US goods must contract. That's what's going to generate a dollar appreciation on impact, even as we'll show you when relative US consumption collapses in the presence of home bias. And that's why this model is able to rationalize or go past this reserve currency paradox, which Matteo emphasized. Again, as he pointed out, in the presence of home bias, if the US is relatively more risk tolerant, its consumption falls in bad times. With home bias, the dollar should depreciate. In our model, on the supply side, the force that's counteracting that, and quantitatively we'll argue is dominant, is that the relative supply of US goods contracts, underlying a dollar appreciation. Let me build more on that in the coming slides, but that's the main thing to take away. Okay.
So we necessarily get a deeper recession in the US than abroad, which is how you're connected to these papers by Caballero Farhi and Caballero Gurincha. If I was to think about the Swiss franc, which has similar beta properties to the dollar, would it have to follow that Switzerland has a deeper recession as well?
Yes, it would. And, anecdotally, we think of this as like capturing well the concerns about the Swiss over the last 5 or 6 years regarding the appreciation of their currency and the worries they had on the real side of the economy. There are, let me say two things since we're talking about it right now. One is we have some empirical evidence in the paper documented that in fact, in the conditional responses to CIP deviations, which you think of as proxies for dollar demand shocks, you in fact do see that the recession in response globally is worse in the US than the rest of the world. But with that said, you can add other bells and whistles to these models so that in terms of the co-movements implied by the model, on average, output volatility is smaller than the US, than in the rest of the world, even though in response to this shock, it is going to be bigger, matching all the co-movements. I'm happy to talk more about that offline for those that are interested.
Okay, and I'm sure you'll get into this, but the US, what seems a little odd here is the US gets this deeper recession, and in a way, it loses money by being short dollar bonds. And it's happy doing that. And yet we had the same risk aversion in the US and abroad.
Well, no. So here, by assumption on this slide, I have assumed identical portfolios.
Right.
On the next slide, we're going to talk about heterogeneity and risk-bearing capacity. And then the argument's going to be the US is happy to lose money and act as a global insurer for the rest of the world because it is more willing to bear risk vis-a-vis the rest of the world. Okay, so let me get to that. So what's the role of heterogeneity in portfolios? I think about a positive dollar demand shock. On impact, there's going to be negative realized excess returns on capital and on the dollar carry trade. Why? Absent nominal rigidity, there's higher real returns on dollar bonds because there's been deflation. And so if you're borrowing in dollar bonds to hold capital or buy foreign currency, you just lost money. With nominal frictions, you also have these real effects. The price of capital declines because there's a recession, and the dollar appreciates, so you have less returns from holding a foreign bond portfolio. As a result, there's going to be, as we just discussed, a decline in the US wealth share and net foreign assets if the US is levered in capital and if it is a long position in foreign bonds. But going forward, and building on Arvind's recent work with Zheng Yang and Hano, going forward, there's going to be positive excess returns on capital in the carry trade because you can now finance yourself at low interest rates. So how are agents actually going to choose portfolios? We can prove that bankers globally are going to be levered in capital. Someone needs to hold capital. Bankers are more risk tolerant. They don't mind bearing the TFP risk. They're going to hold it. And so how do they hedge out the residual risks in their bond portfolio? Bankers in each country are going to be more short dollars than workers if they really value being able to earn those carry trade returns going forward, which is going to be strong if beta is high, more than they care about losing wealth on impact of the dollar demand shock, which is going to be governed by 1/phi, which is the Taylor rule. And so, as I said, this builds on the work of Arvind and others, explaining why heterogeneity and risk-bearing capacity in our model is central to explain why we see heterogeneity in portfolios to begin with. So there was a lot of economics in just the last two slides. Let me sum up, and then I'll show you some pictures to reiterate this message before we go through some quantitative applications. Taking stock, what is going on in this model on impact of a positive dollar demand shock. There's a dollar depreciation, a dollar appreciation, a global recession, a decline in US net foreign assets. Ex ante, there's going to be a negative risk premium on dollar bonds, and risk tolerant agents are going to be short dollars. Okay, so I'm sure there are still some questions. Let me show you some pictures in the full model that's going to reiterate these points and then go through each of those applications one by one to see how it can match them. So we're now going to solve the model, the full model globally. What's key in this model? Heterogeneity and dollar demand. So let me talk just sort of about the key calibration targets, and I'll leave it for you to read the paper to see the details. So the heterogeneity, both within and across the key moments that we target. First, we're going to associate bankers with the non-financial corporate and financial business sectors in the US. And so using the financial accounts, we're going to go measure their leverage in underlying capital in the data. We get 1.7 on average over the last 30 years. That's the leverage of bankers we're going to target in each country. Second, we're going to go to the financial accounts and ask, what is the share of US wealth owned by the non-financial corporate and financial business sectors? 30%. That's going to be used to target the wealth share of bankers in the US. Third, the US net foreign asset position in capital is positive. The US is long this capital portfolio. We get that from the Bureau of Economic Analysis. That's going to then discipline the wealth share of bankers in foreign versus the US. In particular, there's going to be a fewer measure of bankers in foreign than in the US to rationalize the US's levered position overall. And finally, we're going to use the TIC data to pin down the net foreign asset position of the US in foreign bonds relative to wealth, which is positive. So consistent with the literature, the US is short dollars, long foreign currency. And we also use that to discipline our model. In terms of omega, we discipline its stochastic properties by arguing, following the work of Duhem and Schrager and Arvind and Hano and Zheng Yang, that we can use the deviation in covered interest parity between treasury bonds and bonds issued by other G10 currencies as a proxy for this dollar demand. Importantly, to the extent that borrowing in foreign currency and swapping into dollars gives you some convenience yield benefits of still borrowing in dollars, the CIP deviation is probably going to be a scaled down version of the true dollar convenience yield. And so to that end, we discipline omega's autocorrelation and other correlations, let's say with disaster risk, with this series for CIP, but we don't use it to discipline the volatility of these omega shocks. Instead, we internally calibrate the volatility of the omega shocks to match the volatility of expected dollar carry trade returns implied by model and in the data. And so what I'm going to show you in the remaining 12 minutes I have is how do some of the basic economics work out in impulse responses that we just worked through in the analytical results, and then walk through each of the applications and finally conclude with some policy analysis. Okay, so before we talk about dollar demand, let me pause and again reiterate sort of a question that Arvind raised earlier. Why has this been a puzzle? Why has this been so hard to get right in the literature to date? And so I want to walk through the effects of an increase in disaster risk as a counterpoint to illustrate why dollar demand shocks here are so interesting. So what you see here is 6 panels. On the top left, an increase in disaster probability. Top middle, realized excess returns on equities versus dollar bonds. Top right, the dollar real exchange rate, where positive means the dollar appreciates. Bottom left, theta, that's the relative wealth share of the US versus the rest of the world. Bottom middle, the US net foreign asset position relative to wealth. And bottom right, US output. And what you see here is that on impact of an increase in disaster risk, what happens? There's a collapse in equity markets on impact, and then higher excess returns on equities going forward because of a higher risk premium. Importantly, there's a global recession, that's the bottom right. Log Y goes down in the presence of nominal frictions, building on the literature on uncertainty shocks. An increase in uncertainty generates a recession, even if the intertemporal elasticity of substitution is less than 1, as it is in our model. But crucially, because the US is relatively more risk tolerant than the rest of the world, its wealth falls because it's a levered investor in capital. Theta falls. And the dynamics of theta, as it then recovers, as the US earns those excess returns, are reflected in the dynamics of Q, the real exchange rate in the top right. In particular, the dollar counterfactually appreciates when excess returns are high and output rises in the presence of home buys. And this is what Matteo called the reserve currency paradox in his job market paper. And so that's why these frameworks focus on heterogeneity and risk-bearing capacity. It's very difficult to get these co-movements right. So why do dollar demand shocks, why are they successful? In parallel with the analytical results I showed you, I want to decompose it in 3 steps. Let's look at the same 6 panels. First, the model without nominal rigidity. Then the model with nominal rigidity, but the same portfolios. And then the model with nominal rigidity and heterogeneity in portfolios, just as we did in the analytical results. So what you see here is on impact of a positive dollar demand shock. Absent nominal rigidity, there's movements in excess returns. On impact, dollar returns are high, and then going forward, they're low. But everybody holds the same portfolios. There's no redistribution. There's no real effects on the economy because there's no nominal frictions. So Q, theta, NFA, and Y are all flat. With nominal rigidity now, there's going to be a decline in output. And in fact, what you don't see here, but you have in the paper, is the decline in output in the US is worse than abroad. And that's why in financial markets, there's an appreciation of the dollar on impact, followed by a depreciation. But absent heterogeneity in portfolios, you see virtually no movements in US net foreign assets and no movements in its wealth share. Once the US is more risk tolerant than the rest of the world, now you see that its wealth share and net foreign asset dynamics track those of excess returns. And so stepping back, what do you get? That going forward, the dollar depreciates as excess returns are high, output rises, and US net foreign assets recover, exactly as in the data. And I'd ask you to look at the paper to take a look at some impulse responses we ran in the data using CIP innovations that validate each of these predictions and co-movements comparing the model versus data on a number of dimensions. So let me pause before we keep going in case any questions I should answer.
I think, let me see. I think it'll be useful for you to run through the quantitative stuff with 8 minutes left rather than pausing now.
Okay. Ex ante, let me just say that the model generates a positive average carry trade return of borrowing in dollars going long foreign currency, and risk tolerant agents borrow in each country, so their bonds relative to wealth is negative, disproportionately so in dollar bonds. Both of these predictions would be reversed absent dollar demand shocks. And I'm happy to talk about magnitudes during the Q&A. Okay, so in the remaining time, when we walk through these applications, now that you understand the main economics. First, the countercyclical returns on the carry trade, next, the valuation channel, and finally, monetary asymmetries. So first, the dollar carry trade. So think about the strategy of borrowing in dollar bonds and then going long foreign bonds. We'll think about it over a 4-period horizon. In the data, the return on the dollar carry trade exhibits countercyclical expected returns. Following the work of Hano and co-authors, we see in particular that when US interest rates are low vis-a-vis foreign interest rates, that forecasts high returns on the dollar carry trade going forward, and US interest rates tend to be low in recessions. And secondly, the decline, year-over-year decline in US output, real GDP, forecasts high carry trade returns going forward. Our model generates exactly these qualitative predictions in terms of their sign, and absent dollar demand shocks, as you see in the right 2 columns, we would not be able to generate those predictions. One thing I'll just note, especially in this literature, it's kind of not just about getting the sign right, but can you explain why interest rates are low and the dollar depreciates going forward? In other words, can this coefficient on the interest rate differential be bigger than 1? In our baseline model so far, it's not, but in the last few days, it's been clear that interest rate inertia in the Taylor rule is sufficient to get this thing bigger than 1, and because that characterizes the data, we're quite confident the model will be successful in even generating coefficients close to 2.8, and I'm happy to talk more about that offline. Economically, what's going on here? On impact of a positive dollar demand shock, US interest rates fall and output declines, and that forecasts high carry trade returns going forward. Second, this valuation channel. So 15 years ago, Grinshas and Ray documented this important role of changes in the value of the US external position in accounting for the movements of its net external position over time. We first construct the measure of net external position that they do in their paper. And then we demonstrate that it can forecast asset prices exactly as they argued. In particular, over 1 quarter ahead, 4 quarters, and 20 quarters, we use NXA to forecast excess equity returns on the global index, as well as the dollar exchange rate. And consistent with their paper, lower net foreign asset position in the US forecasts higher equity returns and a weaker dollar. Our model generates exactly these predictions, and absent dollar demand shocks, it would basically totally fail, particularly in forecasting exchange rates. Why? Because on impact of a dollar demand shock, the US net external position collapses as asset prices decline and the dollar appreciates. Going forward, that forecasts high excess returns and a dollar depreciation. Absent dollar demand shocks, disaster risk can move excess returns, but you're not going to get enough movements in the dollar. We can also decompose the variance of the net external position into news about future net export growth and news about future returns. We can also use our model to ask, where do those return variation come from? Excess capital returns or excess carry trade returns? Sort of headline finding of the Grinshas and Ray paper in 2007, and as they refreshed in recent work, was that roughly 1/3 of the variation in the net external position is due to news about future excess returns, these valuation effects. Our model generates a comparable 20% share of fluctuations in net external position through valuation effects. And you ask, where does it come from? It comes completely through movements in excess returns, not the level of returns. Okay. Absent dollar demand shocks, these would all be substantially smaller. And in particular, the carry trade in particular would do nothing in explaining the movements in the US external position through valuation effects. And finally, in terms of monetary asymmetries, let me provide an overview of what our model implies. So in our last paper, Moritz and I argued in a closed economy with heterogeneity and risk tolerance that monetary policy easing would systematically redistribute wealth to relatively risk tolerant agents. Why is that? Well, risk tolerant agents hold levered portfolios and capital, borrowing in nominal bonds. And so on impact of a monetary easing, there's inflation, which inflates away the nominal debt owed by these risk-tolerant guys. You also have an increase in profits and the price of capital, which raises the wealth of these risk-tolerant guys. In the present setting, there's some complications. There's two nominal assets, foreign bonds and dollar bonds. So in which currency do agents borrow? And exchange rates also redistribute. Importantly, because dollar demand shocks imply that risk-tolerant agents globally finance themselves in dollars, going long foreign currency and capital, our model then implies that a US easing redistributes more wealth to bankers globally than a foreign easing, because bankers are short dollars. In particular, a US easing causes a depreciation of the dollar and inflation in the US. Both forces mean that the wealth of risk-tolerant bankers who've borrowed in dollars has gone up. One way to summarize this is using a Campbell-Schiller decomposition. You can ask what component of the increase in excess returns on impact of a US monetary easing versus a Euro area monetary easing is due to news about future dividend growth, news about future real rates, news about future excess returns. Consistent with this literature on the global financial cycle, in our data we find that more than half of the increase in the stock market in response to the US easing is due to news about future lower excess returns, basically zero for a Euro easing. Our model generates exactly this asymmetry. And importantly here, I want to contrast this with existing work emphasizing that monetary policy affects the convenience yield itself. That's not what's going on in our model. Omega is not being changed by monetary policy, but the Omega shocks are inducing balance sheet exposures consistent with what we see in the data, where the global banking sector is short dollars, such that a US monetary easing then thus redistributes more wealth to risk-tolerant agents and explains why risk premia fall by more than a US easing versus a foreign easing. Finally, in my last minute, let me talk through the policy experiment. So as I said, we treated Omega as a driving force throughout the model, reflecting latent demand and supply side factors. To now ask what is the effect of a change in dollar swap lines on the global economy, you have to get a sense about what is this epsilon parameter. Okay? So as a back of the envelope experiment, we calibrate epsilon based on the evidence from Arvind and Annette in their work on changes in treasury supply and impacts on convenience yields. And then we simulate a $400 billion increase in the supply of dollar liquidity through our model. Okay? Qualitatively, this is just a negative dollar demand shock. And so what does our model predict? There's going to be a dollar depreciation, a global stimulus, particularly in the US. And that's what you see here. On impact, first, excess equity returns are high, followed by a decline. The US dollar depreciates on impact, and output goes up in both countries, especially in the US. In terms of magnitudes, our model implies that a $400 billion expansion of swap lines would have led to about a 40 basis point decline in the value of the dollar, and forestalled a recession that would have been worse by 150 to 30 basis points in the US versus the rest of the world. So with that, let me conclude, and happy to take questions on much of this during the talk, during the last part. In this paper, we argue that we can rationalize a number of features of the dollar in a new Keynesian model with heterogeneity, risk-bearing capacity, incomplete markets, and shocks to dollar demand. In particular, a flight to dollars leads to a dollar appreciation and a global recession. Risk-tolerant agents are the short dollars because the dollar is a hedge. And on impact, the US net foreign asset position declines followed by a recovery. This mechanism generates three patterns consistent with the data: countercyclical returns on the carry trade, a valuation channel and external adjustment, and monetary asymmetries in the financial cycle. And this framework can also provide a unified way to think about the real and financial market effects of dollar liquidity, such as through dollar swap lines. So thanks so much for the time, and excited to hear your questions.
So Ron, I will start with the first question. Great paper. I've seen it now a number of times. There's lots of moving things on a topic that isn't so easy to get nailed all together. One thing that I wanted to follow up on is something that Arvind also mentioned, is this idea that the US suffers a worse recession as part of the mechanism. I suspect that that's the one that empirically you need to map a little bit more and tell us how you think about this. Any further thoughts on how to bring it to a data, the extent to which to rationalize with premium you need that recession? That would be very helpful for all of us.
Sure. Let me show you one picture that we find interesting. It's not the final word. And then we talk a bit about the economics. So these are the estimated effects using a recursive vector autoregression of a CIP innovation on financial market variables as well as real variables. Okay, and what you see here is the CIP on the top left, the real exchange rate of the dollar top middle, interest rate differential foreign minus US. On the bottom left, excess equity returns, industrial production in the US, and then foreign industrial production versus the US. Okay. The top three panels echo a point that Arvind and co-authors have made in recent work, which is that on impact of a positive dollar demand shock, which is going to be proxied by a positive CIP innovation, the dollar appreciates and interest rates are higher abroad than in the US, consistent with these models. What we think is novel and consistent with our mechanism as well is excess equity returns fall on impact and then are high, and industrial production falls more so in the US than abroad. Now, with these VARs, you know, the identification assumptions, it's difficult. I don't mean to claim this is the final word. That's just one piece of evidence that suggests that you have to be careful when you look at unconditional moments. You know, in our model, the unconditional moments of output in the US versus abroad, volatility of output is very, very comparable. On impact of this shock, it's worse than in the US, but on impact of other shocks, it's not. So that's the data. In terms of mechanisms, I would say one way in which there's an easy fix if you don't like this prediction of the model is, if one argues that in times of dollar demand shocks, you also have, for example, in your job market paper, the mechanism you propose, which is a shift of an increase in home bias, okay? You're gonna get all the same exchange rate predictions right, but you can mitigate the decline in output in the US, because it's like in the US, they wanna consume more of their goods. And so there's, you know, if that's a prediction of the model that you don't like, that's a easy fix to get the co-movements going the right way. Importantly, if we just simulate the effect of an increase in home bias alone without the dollar demand shock in our model, you get a boom in output in the US, which we also think is counterfactual, that there's an output boom when the dollar appreciates in these times. And so I think that's a sense in which a mixture of these two frameworks could be useful quantitatively.
Thanks, Rohan. The next question comes from Oleg. Oleg, please feel free to talk. Oleg, you're probably muted. Can you
Okay,
unmute?
yes. Sorry, I'm back here. Hey guys. Rohan, quick question. Well, this is the same question I was trying to ask. So look, if you look at the dollar fluctuations and you try to identify which appreciations are associated with the recession, you're gonna kind of see nine big appreciations in the dollar that are not really associated with the recession. And then there is a big one that's associated with the recession. And then occasionally there are recessions that are not associated with dollar movements, right? So what it tells me is that there are these frequent shocks for demand for currencies, which are not consequential for macro, right? And you have to write down a model which can be consistent simultaneously with the situations where dollar appreciates by a lot without causing any macro spillovers, right? So what it suggests to me that a likely story here is that there are these omega style demand shocks for the dollar that are just unconsequential for macroeconomics, right? And dollar can move and be largely disconnected from macro. And exactly the same thing can happen with the stock market. Like 9 out of 10 stock market movements are not associated with recessions, right? But then occasionally there are macro shocks like 2009 global financial crisis that creates both the recession and a big movement in dollar, right? And so in that sense, I think I understand the story of the dollar appreciation, which has the spillovers to macro, but most of the time that just doesn't happen. So I'm kind of curious how you would reconcile that in your framework.
Sure. That's a useful question. So I think a useful way to think about Oleg's question, and at least how I would respond, and Moritz, of course, feel free to jump in, is through the lens of these three first order conditions you see on the slide. So to recap what they are, it's the consumption-Euler equation, it's capital versus the dollar bond, and it's the foreign bond versus the US bond. Now, I think what Oleg is pointing out is that we sort of have the same omega shock in all three. And we could conceivably, and this is sort of the tack that Matteo and Oleg have done in recent work, argue that exchange rates are way more volatile than is purely explained by these other macro aggregates. And a way to think about that is if there was a relative liquidity or a relative preference for dollar bonds versus foreign bonds that was not manifest in, saving in capital versus bonds period or saving versus consumption today, there would be an additional sort of wedge, call it, in the third equation that's going to move exchange rates with substantially smaller or no effects on the real side of the economy. And so that's a sense in which I think that there's a natural way to extend our framework to generate more exchange rate volatility that is disconnected from other macro aggregates in that way. Now, with that said, I want to push back a little bit on the notion that this shock is purely about exchange rates affecting aggregates. We think of this shock as capturing a flight to safety. And to that end, we think it's at least intuitively a reasonable description of why we see recessions as bad as they are, as well as why the currencies of presumably safe haven economies appreciate in those times. And absolutely, we're not explaining why do agents flock to the dollar in particular in this model. Other people have worked on that. But I think there is something to putting these ingredients together and arguing how can we jointly explain prices and quantities in an environment with a flight to safety like this.
All right, the next question comes from Hanno.
Yeah, I just wanted to take this opportunity to sort of inspect the mechanism, so to speak, for generating these carry trade returns. And the way I was thinking about it is that suppose you strip away the convenience yield part of the story, and just sort of a standard complete markets logic suggests that if a country has a pricing kernel that is more exposed to the global shock, which seems to be the case inside your model, then that country would always earn a lower or even negative risk premium. Its currency would be a hedge for a typical global investor, right? And the reverse would be true for countries whose pricing kernel is less exposed to the global shock. So I was thinking that there seem to be two forces pushing in the direction of generating carry returns on short positions in the dollar. One is sort of this new convenience yield channel, and one is sort of this sort of standard complete markets force. But it seems like the second one is negligible quantitatively. Am I right in sort of reading things that way, or?
When you say which one is negligible quantitatively?
The standard, so it's all about the convenience yield channel, not sort of the other sort of standard asset pricing effect.
It's an interesting way to think about it. I think we need to do more to decompose into the mechanisms that you're talking about. I would say that here's what I feel comfortable saying, and Moritz, feel free to let me know if you think otherwise. When it comes to the time variation in the carry trade returns and the predictability, which we focus on, there it's the convenience yields that are doing all the work.
Okay. Yep.
Yeah, let me leave it at that.
Thank you. Interesting paper.
Thanks, Rohan. I actually also have a quick question, and this is related to the Lucas critique. So let's suppose either the monetary or the fiscal authority in the US have some additional leverage beyond the Taylor rule. Is it in the US welfare's advantage to lower the special convenience yield during the bad times? Could this help the US to suffer a less severe recession?
Sorry, would it be advantageous for the US to do what? Could you repeat that?
Let's say if they issue more bonds and to absorb this convenience yield, to lower the convenience yield during the recessions, would this lead to a lower or a less deeper recession during the crisis in the US?
Yeah, so through the lens of our model, the changes in the supply of dollar liquidity have macro effects on real quantities, and they also have macro spillovers on the rest of the world. And so in particular, you see here that an increase in dollar liquidity in our model is going to generate a global stimulus. We haven't actually looked at welfare, so I don't know if it's a Pareto improvement, but there absolutely is scope for Pareto improvements here because we have both demand externalities and pecuniary externalities in our model. And so I think thinking through the implications for optimal monetary policy in this framework or optimal debt management would be quite exciting. We haven't done that yet.
Okay, thanks. The next question comes from Ganesh. Let's see. We should pull Ganesh into. Okay, Ganesh, you should be able to talk once you unmute yourself.
Okay, thanks, Yang. Yeah, so interesting paper. I guess I was interested in the VAR results for the CIP deviations. So, I mean, I would think that the 2008 to 2010 period is where a lot of the action is happening because US suffered a bigger recession and CIP deviations also spiked a lot in that period, and also due to reasons like counterparty risk, which might be a slightly different story to dollar demand shocks. So I was just interested that are your results robust to sort of other periods, not just the 2008 to 2010 period?
A couple things, just in terms of the way we measure CIP, following Duim and Traeger and Arvind's work with Zhang Yang and Hano, we focus on the CIP deviation in terms of government bonds, not using LIBOR. The idea being we want to focus here on a measure of the sort of convenience yield or liquidity benefits offered by these government bonds, not frictions in the banking sector. And then secondly, all the co-movements in the paper that we both try to argue our model is consistent with and that we disciplined it with are all over the 1995 through 2016 period, if not before. And so I don't think this is specific to the Great Recession.
Okay, thanks.
Thanks. The next question comes from Arvind.
I guess I want to ask you, maybe expand on this question that Oleg was asking you about. We could think about many types of shocks that affect demand for particular financial assets. So you're thinking here particularly about dollar bonds. I could think about other assets. And you're showing us that a particular type of shock helps to drive asset return and quantity patterns in line with the data. Should I think of that in reverse as saying these are important shocks as opposed to other important shocks? We also know that there's flows into U.S. equities, and can I read your work that way? Are you willing to kind of step out and say that your results tell us that these are some particularly important shocks to think about?
I can't tell if you're giving me a softball or a trick question, but
I'm just allowing you to expand on stuff that you haven't talked to us about.
Sure. I mean, let me give you an answer, and I'm not sure I'm answering your question, but then feel free to ask it again. I think, as I tried to communicate early on, I think as Matteo pointed out in his job market paper, getting these code movements right is very, very difficult. And we think it's striking that this type of flight to safety mechanism in a new Keynesian model with differences in risk-bearing capacity can get all these things to hang together. We also think that this is not just a pure wedge, but there are measures of or proxies for this type of convenience yield out there in the data that we can discipline our model with, and we can do this sort of DSG tricks of let's measure impulse responses in the data, compare them against the model. And I think that's what we've tried to do in this paper, and we think that it's a promising way to think through fluctuations, and that these flight to safety shocks could be an important source of fluctuations on their own. Let me leave it there. There may be other shocks that also matter for business cycles, but as I showed you, for example, disaster risk shocks matter to get movements in expected excess returns, but they get a lot of these co-movements wrong. And we can go down the list.
So to what extent,
things that we do in the paper, like shocks to risk aversion, shocks to trade costs, happy to talk about all that offline.
Yeah, so to what extent are you comfortable pushing your model and saying that these are important basic macro shocks, that it's not, these are not just sort of side effects of another macro shock that show up in the world, that it's a portfolio demand for dollar bonds that's driving a collection of macro stuff, as again, to contrast this with, say, what Oleg first asked about, which is thinking about some, say, a TFP shock or something that maybe is driving the world.
Absolutely. I mean, look, I think there's a lot of people on this call who are doing exciting work thinking about where dollar liquidity comes from from deeper models of the banking sector. We're absolutely abstracting from that to focus on the general equilibrium propagation. So I don't mean to say there, I hope, and I know there is more work to be done on better understanding where this omega comes from. But absolutely, I think we'd feel comfortable arguing that these financial shocks could be important sources of fluctuations on their own. They need not just be side effects of other shocks out there.
Thank you, Rohan. The next question comes from Adrian Verlin. Adrian, would you still be interested to ask the question?
Hi, thank you. Ron, it's a really nice paper. It's both a question and actually a suggestion. I think your co-author already answered. You showed us a lot of time series moments, but I think the model can also speak to the cross-section of countries, right? We know that the CIP deviations are negative for low interest rate countries and positive for high interest rate countries. That would be fact number one. And the second cross-sectional fact is that the low interest rate countries appreciate and the high interest rate countries depreciate in bad times. And it looks like you're going to be able to nail both cross-sections, which is something difficult, right?
Yeah, I think that's a fantastic suggestion. We have thought a bit about cross-section. As you can imagine, quantitatively, solving a model like this, even with 2 countries and 4 agents across them, is difficult. But I think that's very exciting. Let me mention another dimension of cross-sectional variation, which we think is a promising way to extend this paper in the future, which is thinking about advanced economies and emerging markets. And then a third, which is on the monetary stuff, the heterogeneous balance sheet predictions across countries in terms of their dollar exposure and how monetary policy would then transmit, I think, is a natural implication of this framework. Finally, your work with Hanno, sort of on the dollar currency risk factor and then as being sort of orthogonal to another carry trade factor, I think it'd be very exciting to ask whether this type of model extended to feature more than 2 countries could speak to that. And we haven't done that yet.